Every single day, forces you've never heard of are moving your money. We all check our portfolios, right? But we kind of rarely stop to ask what's actually pulling the levers behind the scenes.
See, most folks just see the headlines. A massive spike here, a huge plummet there, and honestly, it just feels like total chaos. But it's almost never chaos. There's almost always a highly specific mechanical reason for why billions in capital suddenly shift direction.
The Fed, AI, geopolitics, currency wars.
Most people only see those headlines, but they never quite understand the signal beneath the noise. And that is exactly what MacroSignal is for. In today's explainer, we're going to play financial detective. We are breaking down the precise mechanics behind a major market move that just completely rocked the commodities world.
Section 1. The 6-month gold crash.
All right, so to really grasp this sudden shock to the system, we need to zoom out and look at the macro setup. Back on January 28, 2026, gold hits an all-time record high of $5,589 an ounce. But then, over the next 6 months, the bottom basically falls out. By June 24th, it had crashed all the way down to roughly $4,002. But then early July rolls around and boom, we get this sudden, sharp jump. On July 2nd, it pops nearly 1% to about $4,075. And the very next day, July 3rd, it spikes another 1.47% to hit $4,183 an ounce. So, what on earth caused that sudden reversal?
Section 2. The June jobs report shock. Well, the answer to that massive price spike lies in a highly anticipated economic data release that completely caught traders off guard. The market consensus, what everyone was expecting, was that the US economy would add about 110,000 jobs in June. But the actual print, it came in at just 57,000 jobs. I mean, that is an enormous miss. It was the smallest rise in 4 months, literally about half of what the market had priced in.
And the weakness didn't even stop there. The unemployment rate unexpectedly stood at 4.2%, which was driven in part by workers actively leaving the labor force. We also saw major weakness in specific sectors. Leisure and hospitality, for example, shed 61,000 jobs, and that's despite the typical seasonal boosts you'd normally expect during the summer. Across the board, this data painted a glaring picture of a cooling labor market.
Section 3. The interest rate mechanism.
Okay, so you might be wondering, why does a weak jobs report cause a shiny metal to suddenly jump in value? It really comes down to trader psychology and the interest rate mechanism. The very second that weak 57,000 jobs number hit the wire, traders instantly repriced their expectations. Before the report, the CME FedWatch tool showed a 67% probability of a September rate hike. Immediately after, those odds plummeted to a 50%. Because, think about it, if the economy is cooling down, the Fed doesn't need to hike rates to fight inflation.
And here is the absolutely crucial concept you need to grasp to understand gold. It's called opportunity cost. Look, gold is a non-yielding asset. It doesn't pay you a dividend like a stock does, and it doesn't pay you interest like a government bond. It just sits there. So when interest rates are high, the opportunity cost of holding gold is also high, right? You're missing out on the risk-free interest you could be earning in cash or bonds. But when expectations for interest rates drop, suddenly that cash in the bank isn't paying out quite as much.
So let's map out this exact causal chain, because this is the real secret here. Step 1, we get a terribly weak jobs print of 57K. Step 2, traders lower the odds of a September rate hike down to 50%. Step 3, lower expected interest rates mean a lower opportunity cost for holding a physical rock that pays no yield. And Step 4, because holding gold is suddenly way less penalizing compared to holding bonds, traders buy in and the gold price spikes over 1% on the exact same day. That right there, that's the true signal beneath the noise.
Section 4. Geopolitics and the dollar.
Now, markets are deeply complex ecosystems. While the jobs report acted as the match, there were secondary global forces already pouring fuel on this fire. First up, the US dollar was on track for its largest weekly decline since April, which naturally makes gold cheaper for foreign buyers. Second, easing tensions in the Strait of Hormuz meant shipping was recovering, which lowered oil prices and kind of soothed those lingering inflation fears. And finally, massive institutions are quietly accumulating the metal. With central banks adding a net 41 metric tons of gold to the reserves in May alone, you have this incredibly solid, fundamental bedrock of institutional demand.
Section 5. The $6,000 price forecast. So now that we understand the actual mechanics at play, where do the major institutional players see this going next?
The big number making waves right now comes from JP Morgan Global Research. They are forecasting that gold will push all the way to $6,000 per ounce by the fourth quarter of 2026. They're basically citing longer-term risks around inflation and the systematic gold purchases by central banks, especially players like China, who are actively diversifying away from the US dollar.
But to keep things totally impartial here, we definitely have to look at the bearish side of the aisle too. For instance, Goldman Sachs just recently cut their gold target from $5,400 down to $4,900. Why the drop? Well, Greg Shearer, the head of base and precious metals over at JP Morgan, hits the nail on the head regarding the exact risk. He notes that if employment suddenly shows buoyant momentum and inflation accelerates again, the Fed is going to be forced to keep rates higher for longer. And as we just learned, higher rates mean higher opportunity cost, which could absolutely crack investor demand and trigger some sustained outflows.
So we've broken down the timeline, that's shocking jobs data, the exact interest rate mechanism, and the geopolitical forces acting on this market. It's a lot of moving parts. So now I want to hear directly from you. Are you buying this dip in gold based on the lower rate hike expectations, or are you waiting for a bit more clarity on inflation and the Fed? Definitely vote in the pinned poll below and tell me your rationale in the comments. Keep learning, keep analyzing those hidden mechanisms, and I'll see you in the next explainer.